I got a new world in my view. Lord, my journey I pursue. I said I'm running for the city. I got the new world in my view. I got the new world in my view. Oh, my journey I pursue. Lord, I'm running for the city. I got the new world in my view.
They ain't got no muscle, no hustle, no backbone. I stand alone, not tripping, just saying I'm different. Ain't hanging on to the coattails of the next man. Passport in my left hand.
Well, good morning. This is Mr. Not Advice. It is Saturday, November 22nd, 2025. As always, this is for entertainment and education purposes only. And this is my weekend update. All right, we had a hell of a week this week. The things I was sharing with my Discord members was, as a professional, we would often look at the Thanksgiving holiday as our start of when we can put things into coast. We sort of just coast into the end of the year. We've made the money that we're going to make for the year. And we're not going to, obviously, we wouldn't be allowing it to the market to take those gains from us. And I had been concerned over the last 3 weeks that professionals at some point would start locking in their gains and would accelerate the losses. And that's what happened this week. And we are still not out of the woods yet. The level of negativity in the markets is at record levels, not what you typically see when the market is within single digits of all-time highs. But speaking to this concept of coasting, I think there's probably a lot of frustration among professionals that, for lack of a better phrase, they're going to have to work through the end of the year and be more focused than they normally would have to be. Okay. Last week, let's get into into last week. This is from Nomura, Charlie McElligott, who I often read. So we had 2 resets this week. The first reset was had to do with AI, and it was Google and OpenAI. Google really moved this week and was quite strong despite the market downturn, and that's because they had what they call a DeepSeek moment with Gemini 3. Now, I am not an AI person, so I'll just accept Charlie's commentary on that. There was a second major reset, though, which was tied to the market's interpretation of the September employment release. While we had unemployment rate or tick up, we also had over 120,000 jobs created. In addition, this is the month of September or October. In addition, we will not get November numbers until after the Fed makes their interest rate decision. So, despite that, and a lot of it had to do with Fed Speaker Williams. Okay, he is a voting member, and this is what he said this week. I view monetary policy as being modestly restrictive. So, restrictive means money coming out of the system or less liquidity, although somewhat less so than before our recent actions. Therefore, I still see room for a further adjustment in the near term to the target range for the Fed funds rate. In addition, Fed Governor Stephen Moran was typically dovish, which he is a dove. He said on Bloomberg, I would absolutely vote for a 25 basis point cut if my vote were the marginal vote. So if it's the deciding vote. Then we had Fed Vice Chair Philip Jefferson say he sees a clear difference between the rise of AI and the dot-com boom. I would absolutely agree. I put in our Discord this week a chart. Med Faber had done an analysis of previous technological and industrial periods of advance. He looked at railroads. He looked at electricity. He looked at the dot-com boom. And what he looked at was what percent of GDP was actually going towards these technological and industrial revolutions. And what he found was that AI, when railroads were being built out, it was over 60%, 60 of GDP. Whereas AI right now is sitting right around 20%. I took those numbers a little bit further and I asked Rock how much of that 60% at railroads was funded by debt, and then all the other instances. And what I found was that, once again, AI is nowhere near as levered as railroads, because at the time, railroads were 50% funded by debt, whereas the AI is under 20%. So, no, we're not in a bubble. I think that AI will continue to drive the market higher, although I am happy to see that market participants are starting to understand that there are going to be winners and losers and not bidding everything up. That's more of a healthy market. Okay. So, and in fact, Vice Chair Philip Jefferson, when he made the comment about the difference between the rise of AI and dot-com boom, he said the firms most closely identified with AI technologies in today's market generally have well-established and growing earning streams. He's absolutely right. So, back in the dot-com era, we would bring companies public that had no revenues, and we hoped that they were able to catch a piece of the TAM for ISPs or internet service providers. Um, and a lot of them didn't. The ones that we brought public did actually quite well. But on the back of those dovish comments, we can see here when Williams talked, we're back up to, in term, where are we at? 64% now odds that we're going to get a December rate cut. However, over the last 48 hours, as of Friday, there were 5 members, though, that were a bit more hawkish. Now, Marin has said that if he's the deciding vote, he will vote for a rate cut. But Barr said Fed must move carefully with inflation. Hammock, rate cuts may prolong inflation. Goolsby, uneasy about front-loading rate cuts. And then Collins, holding interest rates steady would be appropriate for now. I've said this before. The Fed's obsession with inflation is stupid and retarded. I completely disagree with it, and I can understand why they are concerned with it, because the tools that they have available can most directly and quickly affect inflation, monetary policy. So they are focusing on that outcome which they have the most control over, right? Interestingly, the Bureau of Labor Statistics confirmed that there will be no October CPI and that the November CPI will be released December 18th, which is after the FOMC, which means both the doves and the hawks at the Fed are going to be flying blind. They don't like to see that. They don't like to do that because they like to have a reason to justify what the hell they're doing. Yes? So we had a big bounce on Friday, which I don't even call it's a dead cat bounce. And I'll show you what my definition is. But going all the way back to 1957, there have been 8 instances where the S&P 500 gapped up more than 1%, like it did on Thursday, only to reverse and close in the red. So after those 8 instances, 1 day later performance on average was 2.3%. 1 week later, plus 2.8. And then a month, almost 5% higher. And you can see that from this graph, which if you're happy to, if you want to, you can pause it and take a look at that. But that's the effect. On Friday, we had all the majors rallied back above a key to technical support level, which is the 100-day moving average. That's a good start. Okay. The 100-day is not one that I use. So I'd like to see them get back above the 50-day. Yes. Underneath, also mechanics. The market continues to have violent moves. All these charts are courtesy of either Deutsche Bank, Goldman Sachs, Bank of America, or Bloomberg, and I've sourced it from Zero Hedge. The market continues to have violent moves in both directions, and Goldman's trade desk noted that ETFs are still driving the tape at 40% of the volume, okay? Which makes sense because remember, when the government was shut down, the repo or the ability for leveraged ETFs to borrow money tightened up. It almost evaporated and they went to private sources. So what happens if they don't have the money to continue to support their positions, they're going to be sellers, and levered ETFs help lead the market down. So opening that back up in terms of funding, I think is going to continue to add stability to the market. We had healthcare continue to see huge inflows, while tech, the Reds, struggled. Um, Looking at each sector, according to Goldman Sachs sector specialists, tech had another 2% weekly sell off for the NASDAQ, breaking below its 50 and testing its 100-day against against ongoing concern about general AI. Nothing that I am overly concerned about, because I don't think we're in a bubble. Consumer Group was a nice outperformer, but why? Much of it had to do with the other side doing so poorly, AI. And so we also had some very nice earning beats out of Walmart, The Gap, Ross Stores, Lowe's, TJ Maxx. Um, the only one that was somewhat of a holdup was Home Depot, but everything else was pretty strong. There was some acknowledgement about softness in October because a few of the companies, especially Walmart, said that SNAP headwinds had eased, but there was still a headwind. And Lowe's said November trends were positive after they were negative in October. That's very good. Next week coming up, we're probably going to continue to see strong results out of Best Buy, Burlington, Dick's Sporting Goods, and Urban Outfitter. Okay. I don't play earnings, but there you have, according to their sector specialists. Healthcare continued its outperformance streak. Okay. But that's merely a rotation out of AI into something that is providing safe harbor. Financials were very confused this week. There was a fair amount of P&L protection taking place, as we did. We just did it 3 weeks early. And the weakness started with the more hawkish Powell as of the result of the last FOMC meetings we got this week, or minutes we got this week. But if investors were seriously concerned about the macro, banks would be doing a lot worse, and they're not. So the lack of clarity really brought a quieter week in terms of activity, with flows continuing to skew defensive on balance. Energies saw Goldman's trade desk and flow desk saw elevated inbounds on the power front, even though there was a sell-off in the AI energy sector, sensitive names such as energy systems and nuclear and clean tech and battery storage names. Okay. But again, it's very difficult when you have the entire market where they're engaged in profit taking or profit protection to get a good idea of how weak is really weak. Okay. For a sense of the type of rotation that's going on with healthcare, healthcare is now the strongest it's been relative to tech right here. Okay. Since May. And it's testing the 200-day moving average. Very interesting. Mega cap tech it fell for the third straight week, which is the worst, and had the worst weekly drawdown since Liberation Day. AI specific stocks saw exactly the same thing. But there was a standout, and it's a standout that we are trying to get long. Google. Google was the only member of the Mag 7 to close green this week, as its Gemini 3.0 chatbot raised doubts about OpenAI's leadership position. I haven't studied OpenAI. I have heard a great deal of commentary and saw interviews with their CEO. And if even half of what is said about him is true, it'll be inevitable that he will get in trouble and he will do damage to OpenAI's business model. It's inevitable. So I've seen this play out before. Looking at Oracle, Oracle remains the poster child for leverage-driven concerns, with its CDS surging even wider this week and the tech giant breaking below its 200-day moving average. I do not think, though, that this is going to spread. It's going to cause contagion. I don't think that's going to happen, nor do I think that's going to happen with the problems coming out of private equity. A short comment about private equity that you may not know. if you start a private equity firm, each member owner has to put in their own capital. So, unlike a hedge fund, okay, unlike a mutual fund. So, the losses that are going to be taken are going to be felt by the managers themselves. And for the most part, while you may have financial institutions that took down a lot of their private equity garbage, which is primarily focused in commercial real estate as well as consumer lending, I don't see that developing contagion unless we find out that a bank or insurance company is in trouble on a balance sheet or cash flow basis because of their losses that they're having to take in private equity. But my attitudes about private equity is I hope it fails and I hope they lose money because they made bad investments and they've been hiding it. That's called the market. And I don't believe there's no appetite for a bailout of private equity investments because only accredited investors can buy them in institutions. Who wants to bail out the richest? And they're not too big to fail. They can go under without affecting dramatically the rest of the economy, other than making headlines that CNBC can trumpet. Oh, by the way, we had very good news out of Mr. Jim Cramer as he was talking about Bitcoin. He said effectively it's time to sell Bitcoin. So that's usually the bottom whenever he says that, or the top inversely. So momentum stocks did not recover at all, with Goldman's high beta momentum pair basket crashing almost 15% from yesterday's highs. This was the momentum's worst week since November of 2022. We had the most shorted stocks did bounce, but they were also pretty much in a bloodbath. Looking at Goldman's trade desk, they noted that activity levels were actually muted as investors are aggressively watching. They put it about a 3 out of 10 in terms of overall activity flow and skewed about 2% on Friday, skewed better to buy. Long onlys are skewed slightly better to buy, with demand in infotech, communication services, and materials. Long onlys are skewed slightly better to buy, with demand in infotech, communication services, and materials versus supply and healthcare, consumer discretionary industrials. Hedge funds were skewed also slightly better to buy, led by demand in macro products, consumer discretionary, and they were sellers of communication services, financials, and infotech. The VIX topped 28 today, but then was able to pull off its highs. In addition, we had, this is just an ugly chart, crypto had a flash crash, touching a level that we hadn't seen since April in the overnight, testing down to almost 80,000 intraday and on course for its worst monthly loss since June of 2022 when FTX went bankrupt. We are near a bottom. We are not at the bottom. I did read some commentary out of Tom Lee this week that there was a software bug on Tuesday that caused a massive sell-off. While he didn't say it was purposeful, I think that's what he was trying to say. So right now with my Bitcoin and Ethereum trades on BMNR, I'm depending and I'm betting that we're going to get at least an end of the year liquidity rush with the TGA. Now that money being put it back into the market, which is quantitative easing. We just went through a period of quantitative tightening. So it makes perfect sense why you would see Bitcoin and the digitals down, but we're near a bottom. We're not there yet. In fact, the last 12 days in Bitcoin have seen almost nonstop selling pressure. Again, the worst period since 2022. Furthermore, of those 12 days, we have seen massive outflows in crypto ETF. So what are we doing? People are protecting capital and they're also being scared out of the market due to the flash crash again. Again, Bitcoin tumbled to its most oversold on a technical basis since October 2023 this week. And also, we have gold ending the week unchanged, finding support at 4,000. I just saw a report that China latest purchases were 3x, 3 times average volume. So I think gold is back in play. But of course, we'll wait for the price charts to tell us that. Okay, this chart is Goldman's seeing some signs of capitulation starting to emerge in the tech sector. Infotech was by far the most net sold U.S. sector on Thursday, effectively a minus 2.4 standard deviation sell pressure over the last year, massive sell pressure. Managers remain in active P&L protection mode and are actively hedging via macro products. Shorts across U.S. listed ETFs increased 4.6% yesterday and was the fifth largest year to date and one of the largest increases in the last 5 years. It's finally worth noting that 3 of the top 5 daily increases year to date occurred in early April around Liberation Day. So if we're looking for a corollary, then we've got to look to April and see what happened after Liberation Day. Well, if you remember, that's when my members and I started going long the market, was in April after Liberation Day. We're getting close. It's a little bit more complicated because of the end of the year, calendar dynamics, as well as profit protection, but we're not there yet, but we are getting close. Looking additionally at, this is primarily going to speak to CTAs and hedge funds as well as long onlys. Positioning data suggests that most of the selling pressure is most likely behind us. Now, that means according to the news at this point, the information we have at this point, selling pressure is almost done. If a new dynamic comes in, a new catalyst, that's going to cause more selling pressure. Remember, next week, no matter what direction the market is, CTAs, I think they have 18 billion to sell. Okay. So it doesn't matter if the market's up, down, or sideways, CTAs are going to be a minor headwind to the market. However, the buyback window will be completely open next week for corporate buybacks. That's going to help put that invisible hand back onto the market. So taking a look at the S&P 500, it was a beautiful bounce off the 100-day moving average, just as it did back in May. Okay, Liberation Day in April, then May had a further downdraft, and then we bounced. Sometimes, although not often, it can be that perfect and simple, quite frankly. Even NVIDIA today, I had called that huge one. I think I was 176, 180 area, and we bounced. So now we have to see if this huge old this huge big hammer candle on Friday, which was right at the 100-day moving average, if that holds. However, hedge funds continue to reduce their net long exposure. They did it this week, and it's the biggest reduction in net for a long time. Okay, net leverage. That's good though, because bottoms are not created with leverage at record levels. Bottoms are created when everything looks negative, and this is a sign that the amount of borrowing that is levered against their open positions has reduced a bit on a total net basis. I mean, we've probably only reduced it by about 4 percentage points. That looks like 10 from 60 to 50, but that's good. We want to see some of the froth out of the market. Okay. Look at this from Deutsche Bank. And they said, in our reading, equity positioning is now underweight for the first time since July. Perfect. Also something that we will start seeing that starts pointing out a bottom. Systematic strategies, so quant funds, have cut exposure, but are still a little bit above neutral right here. Okay. Discretionary investors who have been focused on risk for the last 9 months have also cut positioning to their lowest level, purple, since June of 2025. Everyone's selling. Yes. CTAs. The comment was, did the CTA puke? Are they one and done? Look, they sold during size. They sold with size on Thursday's move. There is plenty of room to sell more, but sometimes that's all you need is that one drawdown before you start going back up. Another way to look at this is they have a lot of cash now on the sidelines. In addition, I think I've spoke about this earlier, but Infotech again was the most net sold, and they have been selling it 1, 2, 3, 4, 5 out of the last 6 weeks. Okay. So hedge funds are sellers. CTAs have been sellers. That's all good for creating a bottom also. And then finally, single stock option volumes. This is really encouraging because this is retail investors. And for the first time in a long time, we saw single stock option volumes actual drop in November. So that's excellent. Yes. See it back down around the 20% level, whereas before it was pushing up above 37, 38%, which were near highs, not record highs, but near highs. That's what I'd like to see. I want to see those option values drop off also. In layman's terms, people are scared. CTAs, hedge funds, long onlys, systematics, retail, they're scared. They're protecting profits. Well, when they sell, they create capital. Okay. They lower leverage across the market, which is good for an up move. Also, what you want to see when a bottom is being placed is selling. So I'm very constructive. I'm very optimistic that while it may not be next week, we are very near a bottom, and I will continue to monitor order flow. I like to look at from the desks on a daily basis. I get these private reports that tell me what their big name clients are doing, or well heeled clients are doing, both institutions and family offices, because that's a tremendous amount of the volume that goes into the market. It's very hard to absorb that. So I very much like the position that we're in. We may have a little bit further to go, but ultimately, I think we're very near a bottom. Looking at the VIX, people freaking out about the VIX. Okay, really, people? I'm not concerned whatsoever. This is Liberation Day. Look how high we got, 60. Okay, the VIX wasn't even able to close on Thursday, its biggest down day, the market's biggest down day, wasn't even able to close at its highs. It closed 2 points lower. And then now we're back down to below $24. So can this stay elevated for a while? Sure can. Seasonality says it won't, but we'll have to wait and see. Somebody asked me if I'm going to trade it. No, I would look to short the VIX when you get above 30, but I'm not interested in trading the VIX. Looking at individual stocks, Tesla this week. Tesla's a mess. I was talking to Mr. Nichols about this. This has been in this battle zone since September 12th. It's a mess. But so much of the activity in tech stocks right now has nothing to do with the company. It has to do with this overriding fear of, and they will dress it up in pretty words, but the market knew that it had gotten ahead of itself by the sheer amount of dollars that were pouring into AI and tech. They needed a reason. Sometimes the market, what it wants is a reason to go down or a reason to go up. Well, I would say over the last couple weeks, 3 weeks, it's been looking for a reason to go down. It got that reason. Absent a reason to go down, the market generally will levitate up. So that's why I'm encouraged, and I believe we're very near the bottom. Also, let's make a note here for the last 4 weeks, after we got done selling at the top of both EOSE and silver and gold, I think we took 4 trades, but they were all half a position size. They were only 2% trades. So since this past week, I don't think I did. I did a lotto trade on EOSE, but we haven't traded anything. Will we trade into Thanksgiving? Yeah. I don't like trading with low volume, but at the end of the day, if there's a setup, I feel much better this week looking at the mechanical underlying aspects of the market, which I just went over. A lot better this week than last week, but I'm more than happy to wait. I don't need to catch the initial break or turn. Let everyone else do that work is my philosophy, and then I can step in. The S&P 500 today or Friday, bouncing right off this 6,500 level, which I had drawn way back here. We need to bounce, but you heard me say earlier, this is nothing more than a dead cat bounce. Here's what I consider a dead cat bounce. Until you take the day that caused the big red, okay, whatever day was the big sell-off, the next day or the following day, if we do not close above the 50% retracement day of the big candle day, it's nothing more than a dead cat bounce, which means it's not going to last. Okay. When will I decide that, or when will I feel as though that risk is now to the positive side, meaning I think that we're done with the down move, so it makes sense to take on risk to the long side? Well, first thing is we need to close above this 50% level, assuming we're done going down too. So we're not there in the S&P 500. The Russell 2000, now that thing got monkey hammered, but what I saw on Friday is an equal opposite. Not perfect because of the tails, but this is a very powerful, powerful candle formation. Okay. I'd say this about 80% perfect. I don't like the tails. But when you see this much selling with the very next day being this much buying, that's often a reversal signal. It's not enough for me to get long. Okay. I'm more than happy to wait. With that closing at 23.69, I sure as shit can wait till it breaks 24.05. Right. So, and I would do that and express that trade through TNA, which is an ultra ETF. Looking at the NASDAQ market, okay, again, bouncing right off this level, which I had drawn off of here and off of this gap entry. Also, what do you see? Nothing more than a dead cat bounce, and a weak one at that, because it wasn't even able to close at the high of the day. So that's why I'm tentative. I'm not calling a bottom, which I don't like to do, by the way. But I don't think we're there yet, quite frankly. Looking at NVIDIA, not even a dead cat bounce. I think we could probably go down to 165 on NVIDIA. It all depends on Monday whether or not we do a reversal and the market has gotten it out of its system, okay, that it's safe to go back in the water again. That's all I'm looking for. Um, it doesn't mean it's a guarantee, but for sure, if Nvidia can bottom temporarily, that's going to bode well for the rest of the market. Looking at Meta, I think has held up more because it had already experienced this very, very large drawdown. So I have no interest in Meta. I do have interest in Google. Google, despite the market drawdown on Thursday, Friday was a very good day. Yes, we closed slightly above the 50% level, but the chart looks completely different. Okay. Google has stood up extremely well during this market setup sell off. Looking at silver today, big old hammer here on silver. Is it safe to go in? No, not for me. I'm going to have to wait till we break the new highs at 54.41 before I get long the silver asset itself. I may trade some of the miners, but I will not trade this until we break to a new high. This is our range from 54.41 all the way down to, call it 48. We have a 6-point range. We don't trade in the middle of the range, in the middle of the battle zone. So I'll wait. Let the market do the work, not me. And GC, gold, same thing. Yes, we're at 4,000, but quite frankly, this is about 9% higher. I'm more than happy to wait for that to break again. I like taking the low hanging fruit. I like taking trades that are much less risk, even if I have to give up some potential to the top side. Oil. I said it earlier this year. I think oil is going to continue to come down because oil is the single most important inflation component that people feel in real time when they fill up their cars at the gas pump. And therefore, it's the thing that will piss people off the most. So Trump will continue to. I saw they met with the Saudi prince this week and made them a non-NATO most important ally. Big deal. And all of this is being done right now to help support the price of oil to the downside. Looking at Ethereum, just gotten smashed. Okay. Where could we bottom? Down here, 2,000. First 2,500 to 2,000. People ask me, well, when will that happen? Well, I'll tell you when I see it. Bitcoin had a very nice, look at this hammer. Okay. Big old hammer. Amazing, right? It closes right at this level. And how far can we go? Well, we could probably go down to 74 still. I think 80 to 74, unless we get an immediate reversal on Monday, Sunday night. Okay. I think that the seasonals, and if Tom Lee is halfway right about a bug causing Tuesday's sell off, a software bug. In addition, his commentary was when that happens, it's a 5 to 6 week. Actually, he was talking about 6 weeks ago, there was another sell off due to what he called not a manufactured sell off, but it looked pretty close to it. That's about a 5 or 6 week event. We're in the 5th week. He's actually calling that this week. he said on a time basis that Ethereum will bottom this week. Okay, you got to be right eventually, Tommy. So I've absolutely gotten punched in the face on my Ethereum and BMNR positions, but I am holding them because now all of a sudden, not all of a sudden, but as I expected, the mechanical, the structural picture has changed, and it's now much more in my favor, right? We have the government reopen. We have money flowing out of the TGA, Treasury General Account. Okay. We've had a big sell off and across the board of assets. I like to call this week a clear the deck week where everything was being sold. So we have now managers who have locked in enough gains, hopefully, where they can start looking at tentatively deploying cash to the market. And then we have seasonality. I don't think the Santa Claus rally's canceled, but it might be more muted this year. But I do think we're very close to the bottom. Okay. Looking at INV, INV is wild. I have no idea why INV was up on Friday 21%. Volumes continued to be very good compared to when we started to buy a week ago. When we started to buy, INV's volume was sitting around 400,000 on an average day. We were over 2.3 million on Friday. So I remain long INV. I agree with Mr. Ray's that for those who look at high risk investments, this is a candidate that I like due to the potential that they have for their chip to die cooling technology. Yes, EOSE did a couple things this week. They announced an offering on Tuesday. I had predicted that. They priced the offering 30% above the market. The market had closed at 1278. They announced the pricing the very next day for the stock offering too at 1278. And it actually rallied before dropping on Friday. I think we're going to continue to see extreme volatility out of EOSE. There are too many new financial instruments that have come into play. We've got new replacing old convertible debt. I thought that the offering they did was excellent. I thought that it was timely. And talking about this with my members, and I said, when you get a chance, so EOSC right now, all they have to do is execute, right? Usually, before, a year ago, it was, is there demand for their product? Will they have the financing? Yes, the DOE had approved their loan, but would that be enough? There were so many things different a year ago, but look at them now. They've got plenty of money. They don't need to raise another dime now. Okay. They have enough money to fund up to 8 to 10 lines, which they're going to need in order to fill their order backlog. Okay. Number two, they were able to push that convertible debt out by 1 year while at the same time retire some of it and reduce the interest rate. Well, you know what? That reduces dilution. So that was good news too. I think that the Mr. Mahaz said it that now it only takes 90 days to stand a lineup. I think if any delays are going to come, it's going to come out of ACRO and out of the delay in actually constructing and manufacturing these additional lines to be stood up. I think we're going to get more clarity between now and the end of the year. Hopefully, we'll find out what their use of proceeds are specifically. Where are you going to spend this money? Yes, from the offerings. I think also that I still believe it's unlikely that they, unless they sandbag earnings or revenues, I think they're going to come in light on 2025 earnings and revenues, more importantly. I'm okay with that. I'm already looking to 2026. As a side note, I think that's what professionals are doing with the overall market. I think they're looking at 2026 and they are, depending on Trump, going to do everything he possibly can to put as much stimulus in the economy so they can win the midterms. Okay. But EOSC, I have no concern about. I still have 10% to buy. I did do a lotto trade this week, the day before earnings were, or the deal pricing was announced. And some of my members made 30, 40%. I made a whopping 10 because I screwed up the exit on it. So, but that, life happens. That was the only trade I did this week, by the way. So Shorter than usual weekend update. We've got Thanksgiving week next week. Typically, that's a muted period to trade. I will continue to monitor the market. I am taking a week off from meeting with my one-on-ones. I run about 35 to 40 one-on-ones every week with my team members as I continue to teach them and mentor them on how to trade. So it'd be good for me to take that mental break. I hope you all have a safe and happy and joy-filled Thanksgiving. Don't eat too much. And I will be back there will be no end of the day reports next week. They will follow up the following week. We have a very compressed schedule into the next end of the year because we have Thanksgiving is a week late this year. So I am optimistically bullish on the overall market. It's going to take another catalyst to drive the market lower, which could happen. I think there has been maybe sufficient enough P&L protection trades, selling to protect profits, that the market will find its floor this week. We'll have to wait and see. So have a happy and blessed Thanksgiving, and I'll look forward to talking to you in 2 weeks.
I don't play around, trust me. Ain't had as much drive since my Honda Civic got rusty and my girl said she loved me. It's funny, just thinking back, study hard for that 9 to 5 like I thought that I should be good with that. I was dreaming, still dreaming. Spotlight on me like Willie Beeman, still performing like Al Pacino. Instagram and tuxedos with my peoples. We growing up, still don't seem like we slowing up. 10 squad, we throwing up every time that we showing up. Get it while I'm living. All I ever hear's the clock tick, tick, tick.